right, it's 101. Let's get started. Good afternoon, everyone. Welcome to Smart Strategies for Business Owners, 4-session webinars by PACE and Westpac Wealth Partners. Today is almost the last session of the series, and we'll talk about protecting your business value. These webinars are designed to help entrepreneurs just like you to make smarter decisions and avoid costly mistakes and build lasting value. My name is Jeannie Yang, and I'm a business and loan counselor at PACE. Thank you for joining us today. This webinar is brought to you in partnership with the City of LA Economic and Workforce Development Department, EWDD, and BusinessSource Pico-Union Westlake Region, operated by PACE Business Development Center. This webinar will be recorded, and at the end of the webinar, you'll be asked to participate on a survey. So please make sure you complete the survey. And before we get into our topic of the day, I'd like to briefly explain about PACE. Pacific Asian Consortium and Employment. We are established in 1976, and we are a 501c nonprofit organization. PACE is a community development organization that creates economic solutions to meet the employment, education, housing, environment, and business development challenges to low-income residents in the Pacific Asian and other diverse communities in Los Angeles. We offer one-on-one business consulting, counseling, credit, and business asset building, business and financial plan development, webinars, and trainings to help you establish a brand new business or help your existing business. We can also guide you to get into procurement contract if you like. And the greatest fact is that all our services are free. So if you have any questions about our services, program, lending products, please visit our website, pacelabdc.org, for more information. All right, our guest speakers today, Sherbel and Jake, welcome back from Westpac Wealth Partners. It's a pleasure to have you back. Let's get started.
Thank you for having us.
Pleasure having us.
So,
go ahead, Sherbel.
No, just wanted to welcome everybody back. I see some familiar names from our last few sessions, so we'll just run through some quick intros, and today's topic is exit planning. And again, another topic that's near and dear to my heart, but I've exited about 4 different businesses. I was in business with my brother, and then I had a business with another partner. So I'll go through that a little bit, but I'll let Daniel introduce himself, and then we'll go from there.
Pleasure. Hello, everyone. My name is Daniel Alvarez, and I'm a financial representative under Charbel's team. I've had the pleasure to speak in front of the PACE community last year. Last year was mostly catered towards personal planning, but this year I know there's a lot of PACE works with a lot of business owners, and so I decided we should definitely talk about business planning, and that's where we came in with the Smart Business Strategies series, and so I'm excited. This will be our last session of the series, but I do look forward to answering a lot of you guys' questions, and hopefully also meeting you guys one-on-one, just to learn more about your business and how we could possibly answer any questions and also add value. Also, just some housekeeping items too. There is going to be a Q&A at the end, but of course, if you guys come across any questions during the webinar, please feel free to type in the Q&A chat. So if you guys can please test it out, see if it works. Type in your name and where you guys are coming from, and just to make sure that we will get that's up and running. And so go ahead, Charbel.
All right. Well, thank you, Charbel Gabby, again, financial advisor with Westpac Wealth Partners. I'm a retirement income certified professional. I'm also a certified business exit planner. But the certification is different than actually going through it. So I have been there where we've exited. I've had my brother exit a business that he sold for millions of dollars, and was bankrupt 2 years later. And that's because a lot of us as business owners tend to run personal finances through the business. And when the business stops existing, these personal expenses continue. So those are some of the things that we're going to talk about today. What are the strategies to, how to be efficient on the exit, right? Whether it's inside sale or outside sales. So just wanted to bring that story. So again, very near and dear to my heart when it comes to exit planning. So that's what we try to help business owners with. And Daniel, I will control that screen for you. And then,
Yep.
By the way, you're looking at our planning software that we use both on the business and on the personal side. This is more on the business side.
Okay, well, let's get started. Well, I want to show you guys, kind of like a business roadmap, and also, the different phases a business owner will most likely come across during their journey. And let me tell you, there is 100% certainty that you will exit the business. And what we've realized is that, most just haven't planned for it, right? You can click the next slide. And, that could be due to, lack of education. And most importantly, it's going to be one of the hardest decisions that you're going to make in your life, right? Family dynamics could get affected, which could lead to, stress and anxiety. And you can go to the next slide now. Yeah, and you can go like all the way to the, yeah. And so this is how we typically approach business planning. We believe that protecting your business should be the first step. We understand that your business, especially if you've been in the business for more than 5+ years, it's going to be one of the biggest assets that you own. It's providing a source of cash flow for you and your family. And what we've come across is that a lot of businesses skip the first step and focus on growth. There's been many cases that we've come across where a business, due to any unforeseen circumstance, which caused the business to perform, 25 to even 50% less in revenue than the previous year. We understand that, life happens, right? Let's say one of the partners gets sick, a key person of the business decides to leave the business due to life circumstances, or the business owner gets sick and can't perform the daily activities for the business. And life happens, and it is our job to educate. And to be honest, it's not the happiest topic to talk about, right? Someone getting sick, let's say someone passes away. But it's also a priority to minimize and plan for these unforeseen circumstances. Next, we have the growth phase. You may not, at this phase, you're not, looking to exit the business anytime soon, but we still do have an exit plan just in case. Charbel will show you guys a business valuation tool, after later on. And, we often advise to, keep your, always update your business evaluation as much as possible. This will give you a clear idea or even a goal for you to reach. And it could even prepare you to aim even higher. Getting your business evaluated is, sometimes a reality check as well. It may be less or it may be more than you expected. However, we believe it's better to know sooner than give yourself time to grow the business into the target number of your desire. Last thing we want is, you're planning to exit the business in, 2 years, and you finally get your business evaluated and turns out it was less than what you expected. Now your options are to either settle for less or work overtime in addition to the countless hours you've already put into the business. So, that's the last thing we want for you guys. And lastly, we have exiting the business. Again, there is 100% certainty that you will leave the business, and we want to make sure you leave your business, in your terms, right? In its most maximum potential. And you can go to the next slide, Charbel. And click all those. Yep. And these are the 3 doors that every business owner will encounter when they decide to exit the business. Whether that be selling to an insider, which could be a family member or an employee of the business, sell to an outsider, or even keep it till death. Let's say you're in the growth phase and you're still quite unsure. That is totally fine. Like, we do plan to have follow-up meetings at least twice a year, and we understand that priorities change over time, and we'll always adjust accordingly. So next, Charbel will go through the importance of business valuations.
Yep. Thank you, Daniel. So a couple of things that I just wanted to highlight too is when we're talking to business owners and we're talking about their exit, right? Like it's important for us to identify what a successful exit means to them, because a successful exit for me might be different than a successful exit for you. So it could be, is it the highest value? Is it, creating some sort of legacy and keeping the family involved? Is it minimizing taxes? Is it walking away with peace of mind? Is it, you're providing something to the community that you want to make sure that it continues at any cost? So all of those are super important. And that's one of the first things that we do is we figure out what the goals and concerns. The other question we normally get is, well, how, I'm 40 years old. I just started the business. I'm not really thinking about exiting. Right. And that's great. It doesn't mean that there are things you can implement today that will make that exit more efficient and allow you to keep more of what you make in the future. So usually the timeline is 3 to 5 years before you exit is when there's some, planning that needs to be done. And you always want to, again, through the buy-sell agreements that we talked about last week, or was it last week? 2 weeks ago. It's important to, as business partners, well, what if you voluntarily want to leave? What if you're just tired or you don't like your partner? Those are all need to be inside of these buy-sell agreements and these valuation tools that you're going to use for the business. So when we look at the first conversation we have after the goals and concerns is, well, what's the business valued at, right? So if Jeannie and I own a business, or if Daniel and I own a business, and I think it's worth 5 million and he thinks it's worth 1 million. Well, let's see what a buyer's willing to pay for it, and let's put the numbers on paper. So we're able to provide our clients with informal business valuations. And the reason I say informal is it's just giving us a ballpark figure of what that business is worth to give us an idea of how to do some of the other planning. And so we use a tool that's provided to us, and that could be updated, with the next year's tax returns. We go in, we add that 1 year, and then it pops up a new valuation. The other reason the valuation is important is for a buy-sell agreement. So Daniel and I own a business and I want out. What if, I tell Daniel, hey, Daniel, you're going to need 5 million to buy me out, knowing that my half is worth 500,000, right? So there has to be something for Daniel in the buy-sell agreement that says, okay, well, when we're ready to buy each other out, right, this is kind of how the business should be valued, and that's how we determine the price. So those are just a couple of things. But really the question is, what does a successful exit really mean for you? So once we go through the goals and concerns, I want to go through a couple of the scenarios, right? And the reason I tell you efficiency is super important. So in this case, I think I put Jeannie, but I'm going to say Daniel and I own a business, and that business is worth $1 million. One of us plans to sell in 5 years, or we're both planning to sell in 5 years, maybe to an employee, or maybe we're planning to sell to each other. That's why it's 50% being sold. And that's going to be the growth rate. So in order for, let's say I'm buying Daniel out. In order for me to buy Daniel out at 500,000 5 years from now, I'm going to have to come up with some number here that I make, pay the tax, and then give Daniel 500. In return, Daniel's going to take the 500, pay tax, and then end up with some number that's about 350. So maybe I'm paying 700, he's getting 350. You could tell Uncle Sam is part of this transaction, and he's probably ending up with just similar money than the seller is. So those are the scenarios we want to, that's what normally happens with a buyout. So in this particular scenario, this is the amount that the buyer is paying. Then they pay tax. They give this to the seller. The seller makes the 593, pays the tax, and ends up with 485. So there's about $400,000 lost in this transaction. 43 to 44% is being taxed. So the idea is, how could we structure this to be more beneficial, right? How can I sell my portion to Daniel where he's paying less for it and I'm getting to keep more of it, if that makes sense? So that's our conversations, because when we talk to a business owner, it's important to know, hey, do you see this becoming an insider sale, right? Are one of your employees so good and so dedicated that they might potentially buy the business? You know, often enough we get the answer of yes, but that employee wouldn't have enough money to buy me out. Well, if we do it early enough, there are certain strategies such as deferred compensation and certain agreements that could be put in place so that you might be able to defer some of your salary to this employee, and it goes into this bucket, and that acts as a down payment to pay you, and then he would get the loan or she would get the loan for the rest. So there are strategies. Just because that employee is the best but doesn't have money, it doesn't mean it's not possible. Most of the time, it's usually an insider that will give you the highest price. And that's because they know the potential, they understand the business. They were probably watching you for 10 years saying, oh, I could do so much better than Daniel if I just owned the business. Well, that's their opportunity. So we also have conversations with the potential employees and find out, okay, if, you know, John Doe is a potential buyer, does he really want it? So we talked to John. Hey, John, if you had an option 5 years from now to buy this business, would you buy it? And that's what starts the conversation. Any questions on insider sales, let us know. Obviously, I just went through a general example. I'd love to go through what it normally looks like from what we call a third-party sale. So that's just selling to somebody that has no relation to the company, right? And so we're going to have the same scenario here. I'll just walk through it real quickly for you. So we got $1 million business today. That's the valuation. 5 years from now, it's growing at 10%. So it's going to be worth 1.6 million. We're planning to sell 100% of the business, and there's zero cost basis, meaning we just started this business from scratch, not much of a cost basis. So then the tax is on this full amount, the 1.6 million. As a result, there's a capital gains on that sale. And then there might be some debts I need to offset. There might be some costs to the person that's selling the business. But if we just take the capital gains, this is what the net proceeds are. So what our goal is from now until 3 to 5 years when you sell, how could we work with your advisors, with your CPA to try to reduce that number in the future? Could the sale be structured differently for a third party? Can we do a two-part sale? Can we do an earn-out, right? So how does that help us reduce that number of $483,000 in this particular case? And then, oh, I see a question is, I think we answered that one. Oh, so, okay. So one of the things about valuation is, as small business owners, like most of us will look at the business and think, okay, if I'm not there, there's no business. So another part of the business valuation is your involvement in the business. And I don't know if you've heard the term, you know, working on your business instead of in your business, because a lot of times we are just additional employees. But if I'm a buyer and I'm buying Daniel's business, and I know that that business depends 100% on Daniel, there's not a lot of value in that business anymore. So one of the questions on the business valuation is, if the owner were to leave today, how much would the business be affected? And so that's important to know, and that's important to plan for in the next couple of years, is if your business is heavily dependent on you, how do we start delegating? How do we hire a team that's going to do some of the things that you were doing? Because in the long run, it will increase your business value. All right. And then I wanted to go through the, give me 1 second. Let me unshare my screen. So here is what we call the balance sheet of the business, right? So I'll just kind of run through it. These are things that we talk about when we are planning the exit, or even when we begin speaking with the client. Because if I'm planning to sell 5 years from now, Daniel and I are planning to sell 5 years from now. What if something happened to one of us along the way, right? That's where the buy-sell agreement comes in, to protect the business value in case one of us can no longer work or no longer around. We walk outside and get hit by a milk truck. So that's one of the initial conversations. Then we go through and we build out, okay, who are my key employees, right? So I'm going to use Amelia, since she's a child care home provider in East LA. What is, who are the key employees that if they were to leave, your business is affected by a large percentage? And once we identify those employees, what can we do? And I'm sure you've heard the term of golden handcuffs. What could we do to basically handcuff those employees in a nice way to the business and attach them, whether it's to the growth of the business or to the eventual sale of the business? But if I'm buying your business and you have one salesperson that generates 50% of the revenue, I better make sure that when I'm buying it, that salesperson is still there. So those are some opportunities there as well. Then we go through and we talk about, okay, well, in the meantime, until we sell the business, what are some of the strategies that are in place to retain the people that we already have? Not just the main people, but just turnover is expensive. I mean, when I had my restaurants, losing a manager or a cook, or it doesn't matter who it was, you had the cost of bringing somebody else on and then training and then having them stick around. So there's a cost to losing those employees, and we want to make sure that we minimize that. Because if I have a business and it's let's say a plumbing business, right? I want to also know what my local other plumber is doing with his employees, because I wouldn't want to lose any of mine to him. So if I'm paying them the same price, but yet they're giving them a lot more benefits, odds are that eventually that employee might leave. So we want to make sure that that's contained. What type of retirement planning is there? There's a lot of tax advantages, and I know Jeannie's going to mention we're going to do a couple of webinars on retirement planning for business owners and some of the plans that you're able to do for you and your employees. So what are those perks? What are those options? Are there any, executives that are important that we need to make sure to, again, do the golden handcuffs? And then we also want to understand the financials, right? Is this a business that's dependent on labor? Is this a business that's dependent on inventory? Can there be anything, could tariffs hurt this business? We have a transportation company we're dealing with where, when the tariffs were announced, shipments stopped for a whole month, and it's a $20 million revenue company. So it's important to make sure to understand what are the landmines that are going to be there in the next 5 years. Because yes, if everything goes perfectly and your growth trajectory is the same, everything's going to be great. But what if there are some things that happened on the way, and how do we plan for that? Obviously, we talk about the current liabilities, right? Was there an EIDL loan? Was there a PPP loan that wasn't forgiven? How are those being paid? Who's the personal guarantee on it? So if Daniel and I own a business and he personally guaranteed a loan and now he's selling the business, well, we need to make sure that the company is able to pay those loans out. We also speak a lot about the owner compensation, because that's one way to move money from your business to your personal. So how do we do that in the most efficient way? It's giving ourselves a paycheck. It's, if you were there last week when we spoke with Jake, QBI, which is the qualified business income deduction. It depends a lot on how much you actually pay yourself from a W-2. So there are ways to maximize those deductions, and then gives us an opportunity to defer some of that money to retirement planning, but also to move money away from the business into the personal. And then just to give you one more thought, if there's normally when a business is sold, and if, let's just take an extreme example, and there's $1 million in the bank under the business, that's part of the valuation. So if I'm buying the business from Daniel and I'm given a valuation according to his current financials, and there's $1 million in the bank, I expect that when I buy that business, that $1 million of cash is going to be in the bank. So if he were to take that million, then my offer is going to drop by 1 million, which is equivalent to that cash. So how do we move, again, strategically money from your business to your personal? Family dynamics is huge, right? Because if I'm, a father and I have 2 kids working with me and 1 kid doing their other career, right? And I'm selling it to only the 2 kids that are in the business. Well, I kind of want to pass something on to the other child as well that's not business active. They're called a non-business active child. So there are strategies to figure out, okay, well, is there other assets that we can pass? Or maybe have the other 2 kids buy me out fair and square. So those are all conversations that we have. Daniel, do you have anything else to add? Any thoughts?
No.
Okay.
No.
Perfect. Let me see if I think I'm almost done. I just wanted to run. I don't have a sample business valuation that is, but I do just want to touch on the buy-sell agreement, because in this case, I put Jeannie and I as 50% owners, just to give you an idea of how it would work. I'm going to run it through real quick. All right. So basically, just to give you an idea, I'm sorry, Jeannie, but I'm killing you off here. So if her and I own 50-50 of the business, what happens is her half is 500, so my half is 500. Something happens to her, there's no way for her family to get 500,000 unless there's a buy-sell agreement in place, right? That tells us how the shares should be valued, and also tells us if something happens to Jeannie, how I would be able to pay for her half. In this particular case, we decided to fund a buy-sell agreement with a life insurance. So I get $500,000. I give it to Jeannie's family on this side. Jeannie's family gives me the stock of the company, and now I own 100%. What that does is that also increases my basis to what I bought Jeannie with. So if I turn around and sell the business the next day, I don't pay tax on Jeannie's 50%. So a lot of tax advantages on a buy-sell agreement. This is obviously made simple when it's 2 owners only, similar ages, similar health, but there are other strategies to incorporate along. But this is something that we talked about a couple of weeks ago. I just wanted to kind of bring the dynamics and kind of the logistics of how this all works here.
Quick question, sorry,
Yes, please.
But this is based on the pre-agreement between you and I that were 50-50.
Correct. This is usually, the pre-agreement, it's what the corporate records show, right? So if you and I open this company 50-50, that's 50-50.
So it's very important to document it like beforehand.
Of course. So that's part of when you're, setting up your operating agreement and opening the business. There has to be, even if it's your sibling, there needs to be some sort of an operating agreement that says, okay, who put in the money? And then what's the percentage? How are those people going to get paid out upon the exit? And that could then be resaid in the buy-sell agreement.
Okay, great.
Yeah, thank you for that. Now, one of the cool things, just in case, if it was 59-41, so this is a very interesting scenario, because when it comes to business valuation, there's something that's called a discount. So to give you an idea, if the business is $1 million and I own 49%, it's not necessarily worth 490,000. Why? Because I have no majority control over the business or the decisions. So the IRS recognizes that there's a discounting involved. So meaning if the 51% is buying me out, he might pay less than the 490,000 that business is worth. So this 2% is very valuable in the eyes of the IRS, in the eyes of the corporate world, because the 51% person has the say and can, implement any types of policies. So when you have partners that are, again, not 50-50, there's some strategic ways to make sure that, number one, the exit strategy takes the discounting into effect, the valuation takes the discounting into effect. I don't see any questions. That's really kind of all we had, is just to have a conversation. Again, everybody's situation is different. Just know that we're here to educate. We're here to let you know that there are a lot of options, and there are different options that fit different people. So always, we're a resource to you. We're a resource for PACE. But if there are no other questions, I guess we're giving you some time back in your day.
I have a
Jean,
question.
any questions for you? Yeah, go ahead, please.
I have a question. Let's say, this is, everything's like going well, bright, and the business is running well, but what if we have a debt? That's a totally different scenario.
So why aren't we having, say it again?
What if we have company debt?
Yeah, perfect. So that's a great question. By the way, I just found the Q&A window because I had the chat window open.
Mhm.
But so I do have a couple of questions there that I'll come to. So it depends. So for example, if you and I are partners and then there's debt, right? And something happens to me, this time I'll kill me off. There are sometimes loan documents that actually state that the minute that the owner, there's a change in ownership, that debt is due automatic. So then maybe we need to put that into the buy-sell agreement of how is that debt going to be paid? Maybe it's a life insurance on me, just paying the debt. Usually we pass the risk to a life insurance company. That's the cheapest way to do it. But that's one way. If you and I are then selling the business together and it's corporate debt, it's paid out, it comes off of the bottom line. But it doesn't mean, one of the things that our clients always miss out on is if we sell the company for $1 million and we have 400,000 in debt, they think all they pay is they pay the tax on 600,000. That is not accurate. They actually pay the tax on this, what they sold it, minus their basis. And if their basis is 0, they're paying tax on $1 million, then paying the debt. Does that answer your question?
Yes.
Okay. And Nadia, I'm sorry, you said, can you please repeat it? I'm not sure which part you would like me to repeat, but if you want to let me know that. Yeah, so great question on the debt. A lot of times when we took out debt, I had to personally guarantee it. And so when I personally guaranteed it, my house and my assets were also in play, right? Because it was a new company. No bank is going to give me a loan on this new corporation we just formed, on this new restaurant we just opened. They need collateral, and the collateral was my personal assets. So in my particular case, I'm the one who personally guarantee it, but then my brother was also a part, like he was one of the owners. So anything my brother did could also affect how my personal assets are affected. So I didn't understand what Jenny's. Oh, okay. So she was asking how we said when Jeannie's loses out on her that step up in basis. So basically, if we both started the business from scratch, there's something called the basis. So it's basically what determines how much is taxed of the business. So when you purchase your house, and this is your personal property, and you purchase it for 500,000, that's your basis in the house. Any improvements you make over time, that adds to the basis. And then when you sell the house, you take the purchase price or the sale price and you subtract what you paid for it, and that's what you pay capital gains, that's what you pay tax on. So in a business, it's very similar. So in this case, most of us start a business from scratch, so the basis is zero because we didn't buy, Jeannie and I didn't buy this business from anybody. So if I were to get, if suddenly the business is now all mine without any money exchanging hands for Jeannie, when I sell the business for $1 million, I'm going to pay tax on $1 million minus my basis, which is zero, which is $1 million. If there's a buy-sell agreement where there's payment for these shares, now I'm paying Jeannie's family $500,000 for her 50%. Now my basis for her half is $500,000. So now when I sell the business, I subtract her $500,000 because now that's my new basis, and now I only pay tax on $500,000. So there's several different advantages here where Jeannie's family, there's no other way for them to get, this $500,000 in cash unless I sell the business. But in this case, her value in the business is preserved, her family's legacy, and they can continue preserved. This is different than life insurance on what Jeannie was making. So if Jeannie was making $100,000 a year, that's a different value for her family. That's the replacing the income. In this particular case, we're replacing the business value. Sorry, too much writing. So we're replacing the business value for Jeannie and her. So now her family gets the value of the business, which is 500,000. My advantage to me is now I have a step up in basis on her half, and I pay a lot less tax if I turn around the next day and sell it. I hope that makes sense. I hope that was clear.
Okay. Would that be the same scenario if instead of me dying, I decide to sell the business to you? Because I'm no longer interested in this business. I want to sell my portion to you.
Yes. So great question. So in that particular scenario, if I'm going to get a loan and pay you, you now are paying tax on 500,000 because that's your capital gains. And yes, I'll still get the step up in basis, but there's income tax. When it comes to insurance proceeds, it's usually income tax free. So here you would get the 500, but you would then pay tax 150, let's say, and you would end up with 350. Okay. But yes, it would be the same scenario, just you're not getting the step up in basis because your basis is zero.
Zero. Okay. Gotcha.
I hope that, yeah. And those are the tricks of trade with the buy-sell agreements, right? How is it structured? How is the business value determined? Those are in my partnership with my brother, one of the big things we came across was he got a divorce in the middle of our partnership, and he was 51% owner of the company, right? So what happens in that case is he was 51, I was 49. So basically, his wife would have been a 25.5% partner. He would have been, and now suddenly I'm control of the company, and I didn't want control. And also didn't want his ex-wife to be a partner that I have to deal with, right? So the problem is we didn't have a way for us to value the company when it was sold. When he said the value of the company is $500,000, she could say the value of the business was $5 million, give me half. So that creates a lot of issues, and you have to get a forensic accountant to sit there and figure out, okay, what would an average person pay for the business? So all of that should be planned ahead when things are fine. Not when everybody's pissed at everybody, excuse my language, but not when everybody's upset. Then it's really difficult to make those types of decisions because at the end of the day, the people that will lose out are their kids, right? Because they're losing business value, they're losing money that they're giving away to attorneys.
Correct.
So definitely a lot of things to consider when it comes to exiting. And it starts with, and we've put buy-sell agreements in place, a year before the client exits. And now we get conversations from referrals from CPAs that say, hey, I have a client that's exiting in 5 to 7 years. And we're like, that is perfect because there's so many things that could be done in that 5 to 7 year span. The worst is getting a call and saying, hey, I'm exiting this business. I'm in escrow. What can I do to minimize, whether it's my tax or just what are the strategies to put in place? It's like, not much. You're in escrow. Good luck, right? So we can help you after, but we can't really help with making that transaction more efficient.
Planning ahead always helps.
Oh, for sure. For sure. So just wanted to, again, be a resource. Please, I'll put up the QR code just so if you want to book a meeting with us, just have a conversation. It'll have a booking links for us. We're welcome to answer any questions. If you have something specific about your particular situation, please let us know. Let me open up an old one. But that's about it. That's all we got.
All right, great. Great, Charbel and Daniel. Thank you so much for a great webinar. We learned a lot as usual. All right, quick heads up, guys. As Charbel mentioned, Charbel, Daniel, and I are planning on a retirement plan for small business owners, and we're targeting mid-October to early November. So please check back with us, check our website, and make sure you register for the great webinars as well. And I guess that's all for today. Thank you so much for joining us, and hope everyone has a great rest of the day.
All right. Thanks, everybody.
Make
have
sure
a great
you
day.
check it out.
See you, everyone. Have a good day.
Thank you.